Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Cachia, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. And welcome back to Cash Talk. And today I'm joined by Justin from Betashares. Justin, how are you, mate?
Yeah, very good. Thanks, John. How are you?
Yeah, not bad. Thanks for jumping on Cash Talk. We're here in a different studio, guys, talking about something that's been a popular topic of conversation for a while, which is around cryptocurrency. And Betashares really have kind of embraced crypto as like a consideration in asset classes. So I really wanted to get Justin on here to kind of deep dive into that. But Justin, do you want to just explain to the audience around like what's your role and what you do at Betashares?
Currently, my role at Betashares is head of digital assets. And so what that actually entails is leading sales efforts on the digital asset side, providing inputs on product development, but really talking to our clients, mainly advisors and retail, on how digital assets may be suitable for portfolios.
And it's very interesting because that type of role hasn't been around for a long, long time. And I've been in the industry for over 2 decades. And for someone to be kind of at the head of kind of digital assets at a fund manager is quite unique. And so obviously you're working with advisors and you said that you're working kind of with retail investors. Is there a lot of education around just simply like what it is and how it works?
Yeah, certainly. So at this point, with digital assets being a very new asset class versus your traditional assets, a lot of my role is really just being out there and educating on digital assets, what it is, how it may fit into portfolios, and what the future may entail for this new and upcoming asset class.
Justin, it's interesting because like I have been quite apprehensive to think about adding crypto into portfolios, both for myself and for clients. I'm a firm believer on like the asset needs to derive an income to be able to be suitable for me to advise it. Okay. Now, obviously, that is a unique, like not a unique view. It's a view by a lot of people, okay? And a lot of people who are maybe coming from the traditional way of investing. I see this very much as a speculative asset, not a core asset, but it's one of those ones that people may consider once they are already financially free. I'd love for you to maybe just even educate me, which is obviously educating the audience. What are advisors kind of talking to their clients about maybe adding that in, and how can we how can I think about things?
Yeah. So when thinking about digital assets, I think the way that you want to think about it is that it's, and by no means a, get rich scheme. That kind of thinking has possibly been sort of, in the retail mindset, especially when you see the asset go up by, hundreds, sometimes thousands of percent in a cycle.
And that's what we're seeing really a lot of. It's that, hey, my mate's made this, I want to kind of jump on this. And for me, it scares me because, be greedy when people are fearful and be fearful when people are greedy. And they're making decisions based on returns. But when it comes to, which I'm sure you were alluding to, when it comes to like in institutional investing, there's a little bit of a different way, I would imagine.
Yes, 100%. And, the way that institutions take an approach to digital assets is that because it's such a nascent asset class, it really should be looked upon as a alternative asset. And when you think about alternative assets in terms of how much to a portfolio it should be added, it's really somewhere between 1 to 5% is sort of the numbers based on studies that have been done. In order to improve risk-adjusted returns. So by adding somewhere between 1 to 5%, you could increase cumulative returns. You could increase risk-adjusted returns. And as long as you stick under that 5%, number. And that's also considering that you're rebalancing appropriately. You're not actually going to add too much volatility to the portfolio itself. The drawdowns are kept to a minimum, but you can add significant alpha to the portfolio.
And so we're really kind of talking about like a minimum exposure. We're not kind of putting the whole kitchen sink and the whole. Okay.
No.
But it's interesting. Like obviously from our world, I would say that's fair. Yeah. You know, you look at kind of taking a position maybe on an individual stock, or you're going into some kind of speculative asset.
Correct.
You're not kind of throwing everything at it. But you know, I was speaking to an advisor yesterday that kind of just messaged me, and she's like, 62-year-old. I think it was like 1.7 million in a company structure, so no CGT relief as well. 100% of that was in crypto.
I mean, 100% in crypto is a very big number.
62, wanting to retire, and so.
And is that more? Is that a self-directed? It's self-directed investor.
Well, in this case, actually, she was getting advice from a US company that was told her to set up a company and then invest, which is obviously a problem in itself. But this is not the first one. You know, I'm finding people that are not going with those kind of way of thinking in regards to, hey, listen, I want to kind of add in a little bit of alpha here, which is trying to get obviously a little bit of a better return than average, but I'm not going to expose my whole portfolio to, you know, either getting red or getting black at the roulette table. And so, you know, I think a lot of decisions in crypto are being based on emotions, not based on actually data-driven decisions. So when we're talking about like larger investors and they're moving into kind of the crypto space, what's attracting them?
What's attracting larger investors into the crypto space?
Yeah, is it the same alpha? Is it the same risk-adjusted returns? Is it still the same things? Or is it this belief that this cryptocurrency is going to fundamentally change the way that we do things? Like, because obviously there's a few different things that are going on in the crypto world. We've got like this Bitcoin, which is going to kind of overtake as the currency reserve. We've got Ethereum, that's the technology that's going to sit behind this. Like, what are they thinking? Because I must admit, I'm trying to grapple myself with this a little bit, and it might not be. I'm more just alluding to what conversations are happening in regards to the attraction, or is it also simply there's just so much pressure from the public? We need to have something that's appropriate.
Right. So I think there's a few sort of moving parts to what's going on and why institutions are finally starting to get involved. Up until this point, really we were in a regulatory environment that was not favorable to cryptocurrencies, and that environment has started to change. And it really has only started to change in the US predominantly since Donald Trump got into office, since Donald Trump got into office, and has started to change a lot of policies that Biden had in place. Sort of the second point that is leading the way in terms of institutions getting involved is regulated product. So prior to January of 2024, the only way to get exposure was either directly or through futures contracts, which came out over Bitcoin back in 2017. However, if you're a fund manager, and I'm talking about just a traditional asset manager, that's not a hedge fund manager, you couldn't possibly get exposure through unregulated exchanges and things of that nature. And
sorry to interrupt, do you see this regulation continuing to happen? Like, do you see that it's like, obviously when you think about like stocks and you see that the way that they're traded and the way that they're done, even in regards to fixed income products, very regulated. Do you see crypto heading that way?
Well, it's definitely been heading the right way over the last 2 years. So we've had a change of administration in the U.S. One example is the new head of SEC, Paul Atkins, who's now implementing different rules. you know, more recently, we had what was called the Genius Act that was passed in the U.S. Senate that is actually bringing sort of laying down the rules and regulatory framework for stablecoins. And so all of these things are going to be, conducive to the digital asset space and allowing institutional investors, not just institutional investors, but also, for example, corporates to get more and more deeply involved.
I can't help but think that this has a little bit of like the whole like 1980s stock market kind of specky kind of feel to it. Yeah. And what I mean by that is that there's obviously a little bit of unregulation to it, or lack of regulation is probably the better word, which is obviously also stemming the volatility.
Right.
Because you've got these swings that are happening based on emotions, everyone's going in, everyone's going in.
Yep.
And we get into the point where it's so regulated that the volatility actually kind of slows down. And for me, and please jump in if I'm kind of thinking the wrong way, but like long term, does it still hold its alpha when it is potentially regulated? And this is all potential because,
right.
You think about gold, think about commodities, think about all of this, and those alts kind of are in that realm. Whereas when we think about things like stocks and we think about fixed income, we've got that kind of income coming in. Even if we have stable assets like, say, blue chip stocks that are more stable than some of the, X20s or the small caps, I think that and this is my belief, this might not be Betashares, is that when the volatility goes away, is the alpha still going to remain? And I probably question if that's going to be the case. Is that a something that you guys need to look at? And what I'm all talking about, because that might be 10, 15, 20 years down the track, not right now.
Right. So, I mean, no one knows really what's going to happen 15 to 20 years from now. There is no doubt that in 15 or 20 years, depending on the size of the asset, and when I say the asset, just Bitcoin specifically, that type of volatility is, no longer built into the asset, and the same type of gains that we've been seeing is no longer destined for Bitcoin. But taking a step back, looking at from 2009 to 2023, that is the main reason why you had the volatility both to the downside and to the upside that we were seeing, is because it was retail driven. However, given the new sort of regulatory environment and the new regulated products that institutions can use to get involved, we are actually starting to see that volatility start to come back. So I remember, up until 2023, the drawdowns in the asset class itself, were anywhere between 50 to 80%, during their bear markets. In this most recent bull cycle, the largest drawdown, which we saw from roughly 108 to about 75,000, which occurred just a couple months ago, that's only a 30% drawdown. And, one of the reasons is because institutions are now getting involved. But does that mean we're not going to see as much upside? I personally, and a lot of the analysts out there don't think so, because what you have to think about Bitcoin is, it can be used as a hedge to the debasement of currency or the debasement of fiat currencies, but also it is a new technology. So blockchain being a new technology, and there is a lot of upside potential if it starts to become a replacement for gold, if it is, what they say as the money of the internet. With a lot of AI being sort of the big topic now, we're going to have a lot of AI agents, and these payments to the AI agents are going to be through stable coins themselves. And so the way that I kind of like to take a look at it or think about it is, most people have a savings account, they have a checkings account, and they have a brokerage account. you can almost think of Bitcoin as your savings account, a place where anyone that's involved in sort of this digital space, they're going to want to possibly keep their funds in Bitcoin as sort of that hedge against the debasement of currency. You have your checking account. With your checking account could be, that's money that you want to spend that you're going to have to use in the short term. And the money that you may use in the short term are stable coins. Not sure if you're familiar with stable coins, but we could talk about that a little bit. But then you have your brokerage account, which is where, you want to make, your trades and, you're hoping for, a bit of you're speculating a little bit, and that's where other cryptocurrencies can fall into place.
It's interesting because we will talk about that, because another thing that I get a lot from people is around staking.
Right.
And from me, and please enlighten me, it sounds like it's peer-to-peer lending. Yeah, there's like this lending of money and you get paid, which kind of for me is like a kind of debt instrument / business inside the world of cryptocurrency. And then obviously you've got these stable coins that we refer to, and then I think the other one's altcoins.
Altcoins, yeah.
So can you just explain to me maybe what like stable coins are, altcoins are, and what this peer-to-peer lending in a very concise...
Yeah, so look, I mean, stable coins are probably the first place or the best place to start, as they're very simple. Essentially, stable coins is a cryptocurrency that is tied to an underlying asset, or the value is tied to an underlying asset. So it's usually tied to the US dollar. It can be tied to Aussie dollars. It can be tied to gold. But essentially, the value of that stable coin is going to be stable to with the underlying currency. Now, the reason why stable coins can continue to grow and will become more useful in our in our society or in our economy is that there's less friction in terms of using the stable coins, and so if you're making purchases over the internet, stable coins is probably the way that you're going to want to do this. You've probably heard that, Bitcoin, if it continues to go up, well, why would I want to spend my Bitcoin, right? And so that's the whole reason why, you maybe want to hold your money in Bitcoin, but you want to actually use your stable coins whenever you need to, spend money.
And is there a lot of stable coins? Like, as in...
there are, not as many as altcoins. Okay. So altcoins that you mentioned are, there's literally millions.
And are these the ones with the funky names?
Funky names. Yeah. So those are probably the meme coins.
Yeah.
Now I'm not saying all altcoins are useless. It's just that a lot of altcoins are going to go most likely to zero. But there are altcoins that could be successful in the space, but just it's no different when you compare it to the stock market. You may have you have your Magnificent Seven. Well, in cryptocurrency, it's probably not your Magnificent Seven, but you might have your top three, which is Bitcoin, Ethereum, and call it XRP or Solana. That's besides the point. But those are sort of your big names currently. I would I'm pretty confident that Bitcoin and Ethereum will continue will continue to last within the ecosystem itself. But it's just the altcoins, you have really no idea which ones are going to survive, or which ones are going to survive, or which ones are going to be around in 5 years.
It's got a bit of the .com bubble.
It does.
Where you've got this kind of if you had a .com, it was going to be the next big thing, and we'll see where that kind of goes. But before we get into the peer-to-peer lending, Betashares has an ETF in this space, and you might have more, to be honest with you, in regards to investing for retail investors into crypto. Now, when you're investing, is it just stable coins with a mixture of altcoins, or is it just one or the other? Like, what's go there?
So Betashares currently has 3 ETFs that give you exposure to the digital asset space. The first ETF that we listed actually invests in publicly listed companies that are involved in the crypto industry. So it has no cryptocurrencies. It doesn't give you exposure to cryptocurrencies, and it's not meant to track in
Mhm.
cryptocurrencies.
Mhm.
So the companies that are in the ETF itself
Mhm.
are companies such as, Coinbase, which
Mhm.
is
Yeah, I get it.
one of the largest exchanges. You have Bitcoin miners, you have asset managers,
Mhm.
etc.
So similar to like a gold mining ETF,
Correct.
yeah, where
Yeah.
you're not investing in gold, but you're investing in the company that mines the gold. Yeah, get
Yeah.
it.
Yeah.
Cool.
So that's one way.
Mhm.
And then we have two other ETFs that actually give you exposure to the cryptocurrencies themselves.
Mhm.
One is exposure to Bitcoin. The other exposure is to Ethereum.
Mhm.
So it's one or the other.
Mhm.
We do not have any ETFs that give you exposure to multiple coins. And currently, due to ASIC regulations,
Mhm.
there actually can't be any other ETFs right now on any other cryptocurrencies. So
Okay.
the only two that would be in the Australian space,
Yeah.
or sorry, in the Australian market would be Bitcoin or Ethereum.
Yeah, it's interesting. Obviously, the government's having a view on them being the more stable, more
Yeah,
regulated, more, and obviously they want to kind of protect the community in what they believe is
correct.
protect the community. But I know that the government's focus is also on digital assets as well too. They're not shying away from that. I think it was, I think maybe started with Josh Frydenberg. Yeah, maybe a couple of treasurers before. But anyway, um, so from your perspective, actually, before we get into your perspective on how this sits, staking. Obviously, Betashares has nothing to do with
No.
staking in regards to that. Consider that as an added in. Do you see that as an added risk? Is it not on your radar? Like that last piece.
Yeah, so from a beta shares perspective, I mean, it's probably, well, it's not on the radar
Mm.
currently. These so what's staking's been going on in the digital asset space, but what we saw in sort of the last bear market in
Mm.
22, there are a number of protocols that ended up blowing up.
Yeah. Okay.
There was actually a stable coin, that was that actually blew up, that a lot of investors lost money in. And so now that's something that's most likely in the very far future for an asset manager like Betashares. And that kind of technology, while it's here, it's probably still developing, and I wouldn't say something that retail investors should necessarily be looking at. From an institutional perspective, however, it is something that is being looked at. From what I know about what's going on in the U.S., you did mention that cryptocurrencies do not generate any income. Staking is a way to generate income, and for your listeners that aren't familiar with staking, essentially it's in layman's terms, it's tying up your coins. Like, it's almost like you don't have access to your coins. While you don't have access to your coins, you're kind of earning interest because you're putting those coins aside for the protocol itself.
So it's like a debt instrument. It's like, hey, listen, take my $100,000 that I've got in my coins, yeah, and
Yep.
because you're holding them, you
Correct.
pay me a certain amount.
Take
Okay.
my 50 coins, I'm staking it, and because I'm staking it, securing the protocol, I'm receiving interest in the form of additional coins, or back for lending, essentially.
What's your maybe tip for the younger market that are growing up in a society now where crypto is rolling off the tongue very often,
Yeah.
and also I would say the older generation that are approaching retirement? What maybe is your, I don't know, your warnings, your tips, your maybe just two or three that you would give to people?
Yeah, certainly. So tip number one: know what you're investing in. Whether it's cryptocurrencies, whether it's equities that you're looking at, just the next big thing, you need to know what you're actually being exposed to, and where those, what the underlying risks are. So, Bitcoin being the largest and first cryptocurrency is going to have a lot less risk than some speculative altcoin that you're possibly considering. Tip number two would be to have a well-diversified portfolio. So cryptocurrency and Bitcoin is, shouldn't be looked at as a get rich scheme. It should only be a very small piece or part of your larger portfolio, which, your larger portfolio, you should be well diverse. So, you're looking at cash, you're looking at fixed income, and those, cash, fixed income, as well as equities can be a much larger, a larger percentage of your portfolio. So, stay well diversified, and, Bitcoin and digital assets should really only be a small piece. And then in terms of the third, if you don't have the sort of the tools and the resources to kind of do that research yourself. I mean, you're not expected to be a professional in everything that you look at. Use a professional, right? Talk to an advisor that is versed with these types of products. That advisor will probably lead you into using regulated products such as an exchange traded fund, where you have all the sort of protections and regulations in place, and so that if anything were to happen to the ETF itself, you're protected. That's a lot different than thinking you can do it yourself, going through an unregulated exchange, and then having to decide how you're going to actually store these assets, or what happens if for example, you get hacked, and not knowing where to go from there. So I mean, I'd say those are my three biggest tips in terms of if you're planning on getting involved.
And they're great tips. Know your stuff.
Yeah.
You know what I mean? Don't overcommit yourself. And seek advice when you need to. I think that they're really, really valid points. Great tips. Betashares, do you guys have any literature, research, stuff like that they can maybe go on to the Betashares? Because I know there's a hell of a lot of other stuff in regards to Betashares, but is there something there where people can start to just learn about crypto?
Yes.
Regulated crypto, let's talk about.
Yeah, certainly. So on our website, we do have a number of resources. So, we do put out educational pieces on crypto. I myself write a fortnightly blog just talking about the what's going on in the space. And those are really good places to start, just to understand what's going on, what could be driving the price up, what could be driving the price down. And, obviously once you start getting once you start learning about it, that's when you start to ask more questions. And with the asking more questions, you end up learning more about the products, and as well as the industry itself. And then from there, you can decide whether investing in digital assets is for you or not, because it's definitely not for everyone. As you mentioned, 62-year-old, 100%. I mean,
it's going against your tips, isn't it? Really.
Exactly.
Well, I think that's been really, really informative. And Justin, thanks you for jumping on and obviously having this chat with me. Guys, there's a lot that's been obviously covered here, but one of the things that I really kind of got out of this was know your stuff, and that kind of goes into just not just crypto, but if that's equities, if that's using debt instruments, whatever that's going to be, know your stuff. Also as well too, is just around the exposure of these things. Like when we're looking at investing in, doesn't matter what investment class, we're not looking necessarily at the return first. We're looking at the risk. What is the risk that we're adding to the portfolio by making this decision? Because everyone can make money when they're making money, but when you're losing money, how are you exposed? And everyone will teach you about compounding interest and how compounding, gains will work, but check out compounding losses and how hard it is when you're 100% down trying to make 2, 3, 400% up to get back to where you need to get to. It is a very, very important thing to understand the risk. And the third tip that Justin was talking about, which I want to kind of ram home, is around getting the right advice from the right people. Okay. One, not everyone is well versed in this area. So understanding that this is a specialist area to be able to provide you with advice. Two, there's a lot of cowboys out there that are unlicensed, unregulated, and that's like literally getting your financial advice from the plumber at the barbecue. Get the right advice from the right people, okay? I've just gone through the wars with my tooth. I didn't go to the plumber to say, hey, listen, take out my tooth and perform oral surgery. I went to an oral surgeon to do that. So absolute great tips. Justin, thank you very much. Thanks everyone for jumping on and listening. Appreciate it. Cheers,
Great.
mate.
Thank you very much, John.
Thanks, mate.